There is a hidden tax trap ready to snap on the budgets of millions of unsuspecting Americans, including perhaps even you. I will divide this video into 3 sections. First, an example. Second, a little history of the tax provision. And third, some thoughts about what you might do to avoid it. First, let me give you an example. My neighbor, Bob. Decades ago, Bob, a recent divorcee, bought a brand new 2-story home in an attractive neighborhood for $30,000. The last time Bob looked at the value of his house was before COVID, when it was worth $250,000. Age has been catching up with Bob, and he decided to sell his 2-story home and move into a retirement community. Bob put his house up for sale and was surprised to receive a full price cash offer in one day for $550,000. Home prices sure have increased lately. To use round figures, I'm going to assume there were no commissions or costs involved in the sale. Bob remembers that there is a tax exemption for home sales, so he puts the money right into his pocket. But when he files his taxes, he gets a big surprise. Bob has a modest taxable retirement income of $50,000 a year, so he's subject to a 15% long-term capital gains tax rate, although people with higher income can pay 20%. And although he only makes $50,000 a year before taxes, when Bob prepares his tax, he finds out he needs to reach in his pocket and cough up an additional $40,500 federal tax payment, plus a $13,500 state tax payment, and potentially higher Medicare rates, like a $500 plus monthly IRMAA surcharge. I've got a separate video about this issue. Poor Bob is going to pay more than his total annual income in capital gains taxes. The one thing you're likely going to conclude from this example is that you don't want to be a Bob. Now, I was going to use the name Dick in this example, but when I wrote that last line, I figured I'd better change the names. And there are some steps you might take to avoid this problem, but first, some history. Adopted under President Clinton in 1997, the $250,000 exclusion of gain for a single person, or $500,000 for a couple, who sold their primary residence of 2 years, was then generous. At that time, the average sales price of a home was $145,000. But currently, the average home in the US sells for almost 3 times more at $417,000. Profit can easily exceed the $250,000 sales exemption for longtime owners. The tax exclusion is not indexed. It's stayed the same since 1997 and therefore acts as a stealth tax increase. If it had been indexed, in today's dollars, the exemption would have almost doubled and be adequate to protect many middle-class home sellers. It's very much like the tax on Social Security, which initially applied to only 6% of beneficiaries, but because it's not indexed, now applies to more than 50% of beneficiaries. Now, do you think Congress understood this issue when it adopted the law? Of course they did. But they're much more concerned about giving tax breaks to their big dollar donors. Numerous celebrity billionaires pay no or little tax a year, but middle-class voters keep electing and re-electing congressional clowns and getting distracted by hot-button issues while bread and butter issues like rising middle-class taxation gets ignored. Now, what can you do to avoid this tax trap? First, know your numbers. Review your records and be familiar with your tax basis in your home. That's usually what you paid for it, plus certain capital improvements like adding a sunroom or garage. Second, keep your records. When you face substantial tax liability, you want to be able to prove your figures to the IRS. Third, move before you exceed the exemption figure. They say all politics is local, and I'm going to borrow that and say all tax issues are personal. Values have risen so much in my area that today it's possible, but not likely that I would exceed the exemption. But if prices keep going at this rate, it's all but certain that in a few years I will. But the exemption is reusable every 2 years. So if I sell my 2-story home today and buy a neighbor's 1-story home at the same price, my tax basis in the next home will be the new purchase price, leaving me clear of the tax trap for quite a while. The fourth option is the opposite: never move. You're not subject to the tax trap unless you sell your home. Keep it. People talk about there being a death tax, but quite the opposite can be true. When you inherit a house, you generally get a stepped-up basis with a date of death value. If Bob kept the house until his death and then left it to his kids, they would get the $550,000 basis and pay no capital gains tax if they sold at that price. And the final option, add a tax exemption to your family. If Bob married his longtime girlfriend, his tax exemption would double, giving him and Kathy a tax break that could fund a nice honeymoon. Lastly, let me clarify, I'm an ordinary consumer with no special expertise in this area. I'm just exploring it because it affects me. If you are facing this issue, please consult a qualified financial professional in your area and get expert advice. Good luck with your tax planning, and thank you for watching.